All right, good afternoon, everyone, and welcome to the Innovative Leadership Series. For those of you who aren't familiar, the Innovative Leadership Series features business leaders from South Carolina and across the country who cover innovation, leadership, analytics, technology, and entrepreneurship topics. Events are free and open to the public and occur twice per academic semester during lunchtime on Fridays to kick off our residency weekends for working professional MBA in entrepreneurship and MBA in business analytics student cohorts. Today, we welcome Noel Geoffroy, the Chief Operating Officer of Helen of Troy. Noel, thank you for your time today and for joining us. We're looking forward to your presentation. So I'm going to transfer it over to you.
Great. Thanks everyone for having me. It's great to be here on this spring day. Look forward to sharing a little bit of my experiences so far at Helen of Troy on business transformation. I'll share kind of some of my background and a little bit of the experience I have right now leading Helen of Troy and some transformational work that we're doing. And I think I'll also have plenty of time for questions if you have them at the end or along the way. So with that, I will see and try to advance my slides. There we go. I thought I would start with just a quick introduction of me so that you all know who I am. I am married to my husband, Cy, or Sylvain. We've been married for 30 years this year. He was my life-size souvenir from France. So many of you might wonder about my somewhat difficult to say last name, Geoffroy. It came from my husband when I brought him back from Paris 30 years ago. I have two boys. Nicholas, who's in the lower right-hand side, is a junior in the Clemson Life program, absolutely living his best life and super proud to be a Tiger. And my youngest son, Alex, that you see there, is a freshman at James Madison. I'm actually here on James Madison's campus today, here to see him this weekend. And so happy to be able to do this virtually from where I am. Also have a bunny, Riley. You see Riley down in the left corner. My mom in the middle, still full of life and will be 92 in a couple of weeks. And I've got many nieces and nephews, so a full family life with lots going on. I am an all ACC gal. I'm a very proud Clemson graduate. I graduated in 1992. My niece and nephew, who you see in the picture with me, and my niece's husband, my niece and nephew both followed me to Clemson. So we're a proud Clemson family. And my son, Nicholas, as I mentioned, is a Clemson Life student now. So I'm also a proud Clemson mom. I've stayed involved with Clemson. I've been involved with the Irwin Center for Brand Communications, sitting on their board, hiring some interns over the summer and various over the last couple of years. And I also sit on the Clemson University Foundation Board, overseeing with fellow board members the university's endowment. So it's been a great pleasure to give back and serve the university, and I really enjoy doing events like this. Even though I can't see and feel the energy in the room, love giving back like this. And then I did my MBA at the University of Virginia at the Darden School. So was a full-time MBA student way back when. Early on, I only was out of Clemson a couple of years before I went back to get my MBA. I've worked for a lot of different companies over the course of my career. You see them pictured here. Some of them I expect you know and are familiar with, and others you might be scratching your head wondering what they do. I started my career before business school at Corning Incorporated. Corning is a engineering glass-oriented company. I worked in a manufacturing facility where they made television components. So it's actually kind of the prior technology. So we made the glass panel and funnel that made the old TV tubes. So it's all been mothballed now as we've Corning reinvented themselves. Very interesting company, by the way, if you're interested in looking at a company that technologically has reinvented itself many times. But of course, now they make all the flat panel glass, and they make all the glass in our phones and our iPhones, et cetera. So really innovative company. So I was there for a couple of years, went back to business school and joined Procter & Gamble in Cincinnati in brand management. Absolutely loved P&G, spent 13 and a half years there. Wonderful foundation in brand building, leadership, thinking about how to run a business was terrific. And then I went from there to Heinz. Hopefully that's a name that you're familiar with. Heinz, you know, I worked there in the condiment business, leading a lot of the flagship brands. Moved from there to Kellogg's, where I worked in both cereal and frozen foods. Then kind of took an industry change to Sanofi. Might not be a familiar name. It's one of the largest biopharmaceutical companies in the world. It's a French company. So I was able to put my French to work from Clemson and led the North American consumer healthcare business. And I now find myself as the Chief Operating Officer at Helen of Troy. So I touched on, I'm going to talk a lot about Helen of Troy, so I won't go too much now into the various different brands. From there, let's see, I'm having trouble advancing the slides for some reason. Let's try that. There we go. So I've kind of, you know, looked at my career and really have spanned a lot of diverse areas, diverse industries, roles, and experiences. And I'll tell you what I mean by that. You know, as I mentioned, I started in Corning, and it couldn't have been a more technical business to be a part of. Technical electronic components, really, that ended up, you know, going into another component that then went into the making of television. So, you know, very far back in the value stream in electronic products. I then really transitioned to consumer, and I haven't looked back. I love consumer businesses. I love understanding consumer behavior, what makes consumers tick. So, you know, spent many years in consumer packaged goods. As mentioned, I then crossed over into consumer healthcare and personal care when I was with Sanofi. And now I'm in still consumer, but more durables. Most of Helen of Troy's portfolio is in the durable side. I started in manufacturing and operations. When I was at Corning, I was working in a manufacturing facility. I had 48 union direct reports. I was working swing shifts. So a very, very good foundational experience and leadership, leading and motivating people. Then I really transitioned over into marketing. When I went to Procter & Gamble and spent a lot of my career in marketing. I always kind of say I'm a general manager with marketing at my core and in my DNA. And now in the last several roles that I've been in, much more in the general management realm. As I look across the various different contexts and businesses and companies I've worked for, I've really had a broad experience in terms of what I've dealt with. You know, I've had kind of the steady growth businesses where you're just, you know, kind of each and every year evolving the strategy and moving things along. I've done some new category and new brand launches. When I was at Procter & Gamble, we launched a new to the world brand and a new to the world category called Dryel. So it was complete white sheet of paper, which was really interesting. I've done turnarounds. You could say I'm in a bit of a turnaround right now at Helen of Troy. I did turnaround in the Kellogg cereal business. And I've done various restructuring. I did a major restructuring when I was at Sanofi, where we restructured the North American consumer healthcare business, hired about 148 people in 6 months for 6 months. Thankfully, it was before the pandemic, so I got the hiring in then. I'll talk a little bit about some of the restructuring that we're doing at Helen of Troy that I'm leading right now. So a lot of different industries, roles, and experiences across my 25 plus year career. So, you know, I mentioned Helen of Troy, and you know, it's probably not necessarily a company that you go, oh yeah, I know exactly what the brands are. But as I build this out and tell you the brands that we have, hopefully you'll know many of the brands that we have. It's important to kind of, you know, you think about companies as either being a house of brands or a branded house. Helen of Troy is definitely a house of brands. So these are some of our owned brands. OXO, for those of you who spend time in the kitchen and like to cook and like food. Hydro Flask, hopefully there's some Hydro Flask there. I've got mine here with me today. Osprey, great packs, especially if any of you are avid hikers. It's great. Leader in technical backpacks for hiking. Then we move over to the beauty business. Drybar, Curlsmith, Hot Tools are all owned brands that we have in beauty appliances and beauty, now some beauty consumables. So products, to style your hair, both tools and liquids. Pure is an owned brand that we purchased from Procter & Gamble, water filtration business. And then we've got some licensed brands, which again is really interesting. So Revlon, Honeywell, Braun, and Vicks, we sell products under those brands, but we don't own those brands. We license them from their parent companies. Revlon from Revlon, Honeywell from Honeywell, and then Braun and Vicks are Procter & Gamble products that we sell. We license the brand and sell various products under. So that's kind of the brand portfolio of Helen of Troy. It's a company that has evolved over time. It's a 55-year-old company that started, as you can see, back in 1968. And it was really a legacy beauty company that was started in El Paso, Texas by a founder, started in kind of the beauty tools and wigs back then. Over the years, it grew organically, slowly but surely. And then in around 2004, we entered what was called the diversification era. And that's where there was some more mergers and acquisitions that happened. And I'll show you a bit more on the next slide what some of those were. And then in 2014, we started what was called the transformation era. And that's sort of where we are today. We're finishing up the second phase of the transformation. So you can see here the various different steps along the way, or the growth trajectory of Helen of Troy over the last 55 years. As we look at those different phases, I think what's noteworthy in the diversification era is some of the brands that came into the fold. OXO came in early on in that era, and that's today our largest brand. So really good acquisition for us. There was also some consumer products that were purchased then: Infusium, Sure, Pert. There are some names that you might remember from kind of personal grooming and personal care. Those are no longer in the portfolio, but those were acquisitions made during that era. Then there was an important acquisition in 2010 called Kaz. And again, a name you probably don't know, but many of the brands that we have, like the Braun, Vicks, and Honeywell brands, came through that acquisition. And then Pure, you see, kind of came late in that era in 2011. The transformation era, which is what we're in now, that started in 2014, the current CEO, Julian Minenberg, has presided over the company for that full transformation era. He came into the company through Kaz. So he had been the president and CEO of Kaz, which was a privately held company, came in, and then the board of directors decided to appoint him the CEO of the full Helen of Troy company. And he's really been the architect of the transformation era that we're in now. And I'll talk a little bit more about some of the strategies and things that he's put in place over that era. So he's divided the Helen of Troy transformation into two phases, kind of two 5-year strategic plans, which is a typical time horizon for a strategic plan for a company or a business unit. And so phase one was FY15 to FY19. And when Julian came into the company, he really saw, kind of the fragmentation that came with that diversification era that I talked about. Lots of businesses had come in, some were performing better than others, some had more synergy than others. And so he really looked at what needs to be true to kind of bring this together more as a single company versus kind of a collection of various different businesses. And so the image that you see on the left are the set of strategic choices that Julian made for the company as he came in as the new CEO. So we focused on investing in the core. So really looking at the businesses that we had, and instead of adding a bunch of new businesses right away, I really wanted to invest in the core of the company, the businesses. that led to kind of strategic and disciplined M&A. So not just buying anything that became available, but really being more purposeful about where the company wanted to play, where the company had some points of strength, and looking at adding more in those areas, and frankly divesting in some areas where the company didn't have a right to win, and have the capabilities to successfully grow new businesses. He put a big emphasis on consumer-centric innovation. Julian came from Procter & Gamble prior to Kaz and Helen of Troy, as I did. Consumer centricity. Procter & Gamble talked a lot about consumer as boss when Julian and I both were there. And so he really put an emphasis strategically on consumer-centric innovation to help grow the company, and as a key how to win strategy behind investing in the core businesses. He put an emphasis on upgrading the organization and people systems. For example, at that moment, there wasn't a single people system, so he put Workday in place, things like that could really unify the company and allow him to kind of look at the workforce in totality versus a hodgepodge of different systems that had come in. He started to build best-in-class shared services, so HR, IT, supply chain, started to put some of the pieces in place to have kind of shared services that would support all of the businesses, as opposed to them living independently as separate companies. Attacking waste, he saw a lot of inefficiencies in the company, and so that was a key strategy. And then asset efficiency and shareholder-friendly policies. Asset efficiency, Helen of Troy doesn't have any manufacturing operations. So we're 100% contract manufactured. So we're a fairly light asset company. We're a fairly light capital company. And so that is something that he really looked to turn to our advantage as being able to use our cash in M&A, use our cash to invest back into the businesses. And he really put an emphasis on cultivating investor interest in the company. That had not been a priority for the founder. And Julian really doubled down on engaging with Wall Street, engaging with investors to sell the company's story. So that was the kind of the strategy in phase one. Then, phase two, which was FY20 to FY24. So we are in the last year. We've just entered the last year of phase two. We are in what we call FY24 from a fiscal standpoint. What you'll see in the choices here is some areas continue, and that's pretty typical of a corporate strategy, right? You don't necessarily want to throw everything out and start over, particularly in a era where you've had success. And if you remember the chart I shared, they were having success. So you'll see some things that continue, but you'll also see some new choices. So invest in leadership brands. That was sort of the evolution of investing in the core. And I'll talk to you a little bit more about what he meant by leadership brands and how that was unique from a choice standpoint. You'll see a new choice here, double down on international. So Helen of Troy is largely US based, but we have about 25% of the business now is outside of the US. At this moment of time, it was much smaller than that. So doubling down on growth potential internationally was a big strategic choice for the phase two strategic plan. Selective and strategic M&A, that stayed pretty consistent with what was in phase one. And there were some really important acquisitions like Hydro Flask, Osprey, et cetera, that came, Drybar, Curlsmith, that came as part of phase two. Consumer centricity stayed the same, but he dropped the innovation because there's a real importance to not only be about product innovation, but also consumer centricity and marketing, distribution choices, et cetera. A much more inspirational, I think, people strategy: unify, include, and elevate the best people. So really, focusing more on diversity and inclusion, focusing more on the unification of the organization, despite the fact that we had a lot of different business units, accelerating shared service excellence, bringing more and more of that capability to the company, maximizing the operating efficiency, which, was sort of the next evolution of attacking waste, and then optimizing the capital deployment that I talked about earlier. It's a company that does spin out a lot of cash because we don't have a lot of need to invest in manufacturing capital. So, really thinking about the capital allocation strategy and where do we invest the capital optimally for best shareholder return was a key focus. So those are, kind of an interesting look at how the company's strategy, what stayed the same, what was a continue, what was new from phase 1 to phase 2. So I said I'd talk just a bit more about leadership brands and the choice that Julian made there. He started in phase 1 really focusing on the core brands in the company and really understanding which brands were the right brands to be the core. And he created with the leadership team this notion of leadership brands. And you see some of the criteria here on the bottom of this house: differentiated market leader, high margin, so attractive from a financial standpoint, ability to grow, so growth adjacencies were possible, and then asset efficiency. Those were sort of the 4 criteria that he used to look across the portfolio to designate which brands were the leadership brands. And those were the brands that we really wanted to disproportionately invest in. What's interesting is the progression that happened. So if you looked at the beginning of phase 1, about 56% of the company's sales came from leadership brands and 44% of other. As he got into FY22, which was a year or so ago, in phase 2 transformation, based on the strategic choice to focus on these leadership brands, you see that now 81% of our sales are attributed to the leadership brands. So a really good example of making a strategic choice and then really putting your money where your mouth is and focusing there and then seeing the end result of that. That meant that there were some divestitures. I mentioned some consumable brands and personal care like Pert and Infusium and Sure that were divested. And then there were some new acquisitions like Osprey, Hydro Flask, as 2 examples that came into the leadership brand portfolio. You see the growth, the growth accelerating over that time as well with the investment. The other key area to touch on, and something that a lot of companies talk about, a flywheel, and what's important as you're really thinking about fueling growth in a company is to get this flywheel moving. So if you think about leadership brand innovation and investment, so having those consumer-centric ideas that the consumer is going to be excited about and that fit with your brand, and then investing in those starts the flywheel going. That gives you the organic revenue growth. With that growth, you hopefully get margin expansion, because remember, the leadership brands we specifically picked to be accretive from a margin standpoint, so above the company average. So as those brands grow, the margin of the company will expand and grow. That then allows us to continue to invest and leverage high quality global shared services. So it allows us to put some of that margin expansion, invest it back into our capabilities in the business. Debt and tax efficiency, I haven't spoken to much yet, but Helen of Troy has a very unique tax structure. We're a inversion. I won't go into all of the lengthy explanation of what that means, but we're a company whose base is in Bermuda. And we've got various different tax jurisdictions across the globe, frankly, that allows us to be at a preferable tax rate than many US-based companies. So that is a competitive advantage for us, and also allows us to have more to reinvest back into the business versus some of our competitors. Working capital improvement continues to be a key focus. The more that you're efficient from a demand forecasting, supply planning, that working capital, keeping that really tight, that gives you, again, more that you can invest back into the business. I've talked low capital expenditure. We don't have to spend money on big expensive machineries and equipment and plants. And then that allows us to redeploy capital back into growth driving areas of the business, whether that is new M&A. We've done some share buyback over the years, different things like that, that kind of keeps this going. At the core of it, we've got kind of the Helen of Troy outstanding people and winning culture. Julian has done a really nice job of driving a lot of cultural initiatives within the company, a very clear purpose, values, and a set of cultural norms that are really felt immediately upon joining and entering the company. So that's all, the good stuff and kind of the foundation of how the company has been successful over the last 8 or so years. I came into the company in May, so I've been here just almost a year, so a little bit less than a year. And, things were going along really well. You could see that in the graph. I've talked about the results in phase 1 and phase 2. But fiscal year 23 that we just completed in February, a tougher outcome. We saw things really slow down from a net sales top line standpoint, which then translated to the bottom line. That meant stopping the flywheel that I talked about earlier. That was driven by a couple of different things. Some of the macro headwinds that we all see happening out there with consumers. As consumers during the pandemic were very focused on buying discretionary items. People had extra stimulus money in their pockets. They weren't spending it on eating out or going on holidays and vacations. And so we were really fortunate to benefit during that era from those trends. We are now in a place where consumers are tightening a bit. They're also shifting the spend that they're making to more experiences, getting back to travel, getting back to eating out, and not spending as much money on some of the discretionary items that a company like Helen of Troy sells. So if you look at all of those different factors, as well as some of the the things that the company maybe wasn't paying as close of attention to, we saw a negative outcome in fiscal year 23 versus what the company was anticipating and expecting. So that's where the restructuring kind of came in. As I came in and took stock of where we were and what was happening in the company, went to the CEO, the board of directors, and the leadership team to suggest that we launch what we've called Project Pegasus to help us identify some new efficiencies and get the flywheel moving again. We looked across all different aspects of the company to see where we could find those efficiencies so that we can reinvest back into the business. We have various different areas here. You can see the seven initiatives that we've laid out as part of the restructuring, further optimizing the portfolio, streamline and simplifying the organization, accelerating our cost of goods savings opportunity with our supplier partners, enhancing the network efficiency from a supply chain standpoint, reducing inventory, optimizing indirect spending, and improving our cash flow and working capital. So really comprehensive, looking at all aspects. We expect the efficiencies to come about 60% through reduced cost of goods and about 40% through lower SG&A, or kind of our selling and administrative costs. We expect to see it over a 3-year period. It takes time to kind of identify and then flow all of these things through. And it doesn't come for free. There's a one-time pre-tax restructuring charge as we go after all of these various different opportunities. So we kicked this off over the summer and announced, I guess it was in October, and we've continued to kind of work the program. We'll be talking to Wall Street just in a couple of weeks, actually, with kind of the latest updates. This just gives a little bit more detail on some of the different areas of the restructuring. There's a lot here. I won't go into all of it. I'm happy to answer questions about it in the Q&A, but really comprehensive and looking across a lot of areas in what we're bringing forward to drive that next era and that next level of efficiency so that we can reinvest in growth and reinvest in our brands moving forward. when we look at the various different aspects of the restructuring program, it's important to kind of look at how you can do things that will really benefit you across multiple areas. So I'll take an example in something like SKU rationalization. It touches optimizing the brand portfolio, because really looking at items that maybe aren't as profitable or aren't as productive that we can clean up. It enables cost of goods savings. If you look at items that maybe are very productive but don't have great margin, it gives you a focus area for where you can look for cost of goods optimizations. Enhancing our supply chain network efficiency. The less SKUs you have, supply chain people would love you to have almost none. It's back to those old days of Henry Ford. I sell one car and it's black, and that's what you get. Supply chain folks love to have as simple of a portfolio as possible. So weeding out the SKUs is an important strategy there. It also helps with inventory. The less you have, the less SKUs you have, the less inventory you have, and so on. So all of these, projects and programs kind of work together across the various different objectives that we had in order to get the flywheel going and to put us in a more efficient, effective posture for the future growth of the company. One of the big areas that we talked about in the last go around that I thought would be interesting to you all is a new organization structure. We looked at a lot of alternatives, and as I mentioned in kind of talking about Julian's journey from phase 1 to phase 2 for Helen of Troy, they had already made some evolutions. I talked about the shared services that Julian brought to the fore. He had formed business units as well. We took it to even one click further from a centralization standpoint. While we had shared services, I would say we were still, operating in a place where there was overlap. There were places within business units that they opted out of a shared service instead of opting in. And when you step back and look at it from an efficiency standpoint, that's not ideal. You've got the cost of a shared service, and if a business unit isn't leveraging it, you're doubling up there. And so we really took a look at being significantly more centralized and really leaning into that from an organization and a cost standpoint significantly more through this latest round. So we made 3 major changes to the organizational structure over the last couple of months. The first was streamlining our business segments. We had been 3: home and outdoor, beauty, and health and wellness. We streamlined down to 2. So now we still have home and outdoor, that stayed the same, but we combined beauty with health and wellness. We saw various opportunities to drive some synergy there, both from a technical platforming standpoint. Many of them were about heating things. If you think about hair dryers, curling irons, and heaters, for example, that span the 2, there was some really interesting technical capabilities that we could leverage across. We also saw an opportunity from a customer or retailer standpoint. There was a pretty significant amount of overlap with the customer basis there. So just a lot of opportunities to be more streamlined by only having 2 business units versus 3, making it a lot easier for our shared services to interface with 2 versus 3. We also created a North American regional market organization or a centralized sales organization. Before these changes, each business segment had their own sales force. So that meant, for example, that we had 3 separate sales teams calling on Target as a customer, or 2 separate sales teams calling on Walmart. Our home and outdoor business didn't sell to Walmart, so we had 2 Walmart teams, 3 Amazon teams. So you can, pretty quickly see that leads to a lot of inefficiency. So we ended up creating a single North American region market organization with a single Target team, a single Walmart team, a single Amazon team that cuts across our entire portfolio and business, that allows us to be a bigger scaled partner with our retailers when we're kind of strung all together, and it allows us to be more effective and efficient when we're calling on them with common terms, single joint business plans, those sorts of things. So this has been a really big change for us. I will say another opportunity that's already come to the fore is growth opportunities. now I've got a single leader looking across saying, hey, this is really interesting. While we were all selling in Target, we're relatively speaking underdeveloped in this part of the business. How can I leverage one side to help grow the other side? So it can be really helpful to have a different lens or a different way to look at the business and look for growth opportunities in addition to the efficiency side. And then finally, we did some further centralization of operations and finance. As I mentioned, there was just some duplication there, operations in particular, where we had a chief supply chain officer, but there were certain suppliers that he wasn't overseeing. So we've cleaned that up and really put all of the operations into a centralized organization. And that enables our business segments to focus on innovation and marketing. So, as we look at kind of the phases, we had phase one, we had phase two. This project Pegasus has kind of come in at the end of phase two. It sort of elbowed its way in, given some of the slowdown that the business was seeing towards the end of phase two. And then we'll now kind of chart that next course that will start with our next fiscal year. And that's work that's underway now from a leadership team standpoint. I'm spearheading that for the company. And we'll be coming together in June to take a look at where we've been in phase two. Again, as I said before, what do we want to continue? What do we want to change? What do we need to add from a contextual standpoint in order to set us up for sort of that next era of growth and that next era of success for the company? So that's kind of a bit of the journey and where we are from a transformation standpoint. I will open it up for questions. And I think to do that, I might, Matthew, stop sharing so that I can see people more. So let's see how I do that. Stop sharing.
There you go. Perfect.
There we go.
So thank you so much for this incredible presentation. When I look back at I'll start with the first question here. When I look back at your career, at P&G, extremely asset heavy, right? P&G, manufacturing, Cincinnati, huge facilities to do all this. And now you're at Helen of Troy, which is completely asset light, contract manufacturing. Has that been a difference for you looking back? I mean, I'm sure having that P&G experience was helpful, but has it been very different thinking about the business from an asset perspective than trying to be asset light?
Yeah, I think it does. I mean, I've kind of had, I've had a range. I mean, at some point I worked in the paper division at Procter & Gamble, and you can't get more asset heavy than a paper business. Paper machines are literally $500 million a piece. And so, the amount of analysis that you do to determine whether or not you put in a new paper machine is significant. So that's, but, I think now, what's interesting is at Helen of Troy is it does allow a lot more thinking around M&A because you don't have to think about reinvesting back into the equipment. You can really partner with your contract manufacturers on what scale and what you need to do, and it allows you to kind of focus more in that area. I will tell you, that Julian, our CEO, laughs at me. I love manufacturing. I started in a plant, and so I miss that a bit, and so I do. I'm a bit of a plant rat, I call myself. So I love to get out there with our suppliers and spend time in the factories. But it does, I think, allow you to think more about how to grow the business inorganically versus having to reinvest everything back into into your own kind of big equipment capital.
Right. That brings up one other question I have for you on the M&A side, which is so interesting, being asset light. If you're going to acquire someone that has their own manufacturing facilities, is that something that you would immediately want to strip off and not handle? Because when you think about the shared services and the things that you're doing now and the transformations, that all doesn't necessarily plug right into an acquisition. You have to really think through, how to restructure, bringing somebody on board, a new brand or whatnot. Does that change the way you guys think about M&A?
Yeah, it certainly is something that's very much front and center as we consider M&A opportunities. I mean, I would say we're pretty. we really don't want to be a manufacturer at this point. I mean, it's just not, as you think about kind of skill sets and what we're good at, that isn't, our core competency. And so I think it's definitely a criteria. If there was a business we really loved and they did have their own manufacturing capability, we would probably look to see if there was a partner out there that could take that on our behalf versus have us be kind of half pregnant, trying to do two different models. I don't see that in our future. I mean, you never know, but I don't see that really as kind of our focus from a future standpoint.
Makes complete sense. And I'm going to transition here to the student questions, but I just have one more I'm going to give you here.
Yeah.
When you think about the restructuring, and I love the shared services concept in the distribution management and sales teams and putting them all under two different umbrellas, and then being able to go to an Amazon or a Walmart or a Target or whoever it may be. Before, those companies would try to kind of divide and conquer brands a little bit. But now that they have a single point of contact for hundreds and thousands of SKUs, does that change the leverage criteria that maybe you guys have a little bit more leverage with them versus what you had in the past?
Yes, that's exactly right. That was part of the strategy. When you're going up to sell to Walmart, Target, Amazon, et cetera, there's so many manufacturers doing that. You really have to look for how you maximize your scale and your leverage with those different customers. And we were not doing ourselves any favors. We're not the biggest company out there. Some of my prior employers are way bigger than we are. But we weren't, we were almost making ourselves even smaller than we were by, going to market in a separate way. So coming together was an opportunity and is an opportunity for us to kind of leverage our scale and look for some of those opportunities. It's already, we've already been able to do that, in a couple of places with our retailers. And it also allows better share and reapply even internally, right? I mean, there's, selling is a capability. Probably not foreign to anybody. I mean, people who go into sales tend to be extroverts. They tend to thrive on working with others, bouncing ideas off of others. And so having a sales organization up against a customer allows that to happen, allows them, the folks selling on beauty to talk to the folks selling in housewares and say, hey, this is what I used with Target. Target strategy is Target strategy across those customers. So that's another really positive example. I just have to interject. I see on the chat now that I can see the chat. Yes, my son is Slick Nick, and I'm glad some of you know and love him. He's a lot of fun.
Here in the very beginning, we might not get into other questions.
That's right. Yes, he's at every soccer game, every sporting event that Clemson has. He's always front and center on the court at the basketball games. So he's a bit of a legend. Karaoke at TD's every Tuesday and Saturday night. Slick Nick kicks it off.